Well, it's 11 o'clock, Monday morning, new week. You're with us here on a fresh new edition of Trading Hour. I'm Prashant Nair, and shortly Surabhi, my colleague, will be with us as well in just a bit. Well, the market is down and out. It's down about 1% as we start, 110 points down, 10,273. I mean, I made this point on Friday as well, that as of Friday's close, the market on the Nifty was just a shade under its 61.8% retracement. So we'll see where it goes. That number stands at 10,438. There has only been one close above that particular level. That was last Tuesday. The Nifty Bank will come up on your screen as well. And that is basically largely where the pressure is coming from. The Nifty Bank, I think the last I checked, was down over 2% or so. So, I mean, actually, it's recovered a little bit. The last points there, about 1.8, 394 points lower. You know, as we begin a new week, I thought it would be useful to look at where does the market overall stand at now. I mean, as always, we've done this exercise many times in the past, and I'm going to just put some figures out which puts where we are starting this new Monday at, right? So let's just dive straight into it. This is where the market is now, and that is where the market was in the beginning of June. What have we done? We basically looked at stocks which are up over 60% from their March lows. This is the figure as of last Friday's close. That is the figure as of the week ended June 5th, right? And by the way, June 5th was a vast improvement over the previous week. It's actually, the markets have galloped higher is the point I'm making here. 729 stocks. That is about 39% of all listed stocks on the NSE are now up over 60% from their March lows. The figure in the beginning of June was only 23%. That's the extent of the move up that we've seen in the broader markets. We usually talk in terms of large cap indices, but this gives you the full picture, everything which is listed out there. Okay, let's just quickly run through this table. I mean, this is what I was referring to on the screen, up over 60%. So 429. 729 compared to 429 now. So that's a 70% increase. Stocks which are up over 40 to 60%, that number is not changed very much. Stocks which are up over 20 to 60%, that number is declined by about 32%. That is essentially because stocks have graduated to a greater degree of gain. So, you know, stocks which were here have moved up here to being up over 60% now. Look at this figure. So, you know, as you go down the list, in terms of stocks which are not up that much, that list has decreased quite a bit, whereas stocks which are up over 40, 60%, I mean, you know, those numbers have really galloped and become bigger and bigger. Just one last graphic I want to put up for our viewers, which is sectoral picture, right? From their March lows in absolute sense, where have we seen the maximum gains? The pharma index is up the most. It's up 53%. I don't think that really comes as a surprise. The energy index is up 48. Infra, auto, metals, and private banks follow closely behind. The laggards are out there. PSU banks, real estate, and the CPSE index. I've excluded IT and FMCG because they did not fall in that Feb to March period that much, and they're already up about 20-25%. Stocks there are pretty much back to highs. So this is the picture here. Pharma, energy, infra, auto, metals, and private banks. Private banks is a new addition. There was a huge laggard, but it's still at the bottom of the list in terms of winners, but it's now up 31% from the lows. So this is the overall market picture. Okay, you know, if you do believe that what we are seeing here in India is largely a function of not just expectations of recovery here, but what is happening in the US market and the S&P 500, NASDAQ, etc., so then you need to get a word in on what the trajectory for the US market is as well. I mean, that's essentially been the best performing market this year. NASDAQ is up some 17% year to date. I've got a very special guest joining us right now. Kevin C. Smith is founder, CEO, and Chief Investment Officer at Crescat Capital. And he's staying up very late for us. It's 11:30 p.m., 11:30 in the night where he is in Colorado in America. So, Kevin, first of all, thank you very much for taking out the time and effort and staying up late for us. Great to see you.
Thank you, Prashant.
You've sort of sounded the warning bells for some time now, Kevin. You've said that, you know, the market in the US essentially has been running on, in a way, fumes. But Fed liquid, I mean, you could replace that word with Fed liquidity. And you've said that these kind of bubbles don't last. Just explain your position for our viewers.
Well, we believe we're in a speculative mania, and it's really a valuation mania, an overbought stock market, a relief rally that's just gone way too far in what we believe is a global recession that was brought on by a record debt bubble even before COVID-19, and a record long expansion here in the U.S. market. So the combination of the valuations, the speculative mania that we have on all of this Fed liquidity, it's just crazy. And I think it's something that is going to wear off like a drug, and we're going to find that we're still in a recession with the underlying earnings fundamentals just not supporting stock prices where they are today.
Will it wear off, though, is the question. I mean, why can't the Fed continue to keep rates lower for longer? I mean, much longer than anybody expects. Warren Buffett, who you have said, I mean, you grew up reading his annual shareholder letters, etc. He said if rates are going to be much lower for much longer, then equity valuations are not really all that crazy and expensive. How do you reconcile that?
Well, we don't totally agree with that. I mean, low interest rates are one factor in a discounted free cash flow model, valuation model for stock prices, but there are many other factors that go into the discount rate when you're trying to discount future cash flows for companies. And when you have record debt at U.S. corporations, and when you have record slow economic growth because of all of that debt, and when you're in the middle of a recession, there is no premium valuation that's justified at all.
Do you think, Kevin, the Fed will start to taper anytime soon? Because the thing also is that they may slow down future fresh asset purchases, but they don't rewind, they don't sort of pull back on the balance sheet. The balance sheet expands, it stops growing at the same rate, but it stays where it is. That is a big improvement. I mean, if you wanted that as underpinnings of a risk rally, it's greatly supportive compared to a year back or 2 years back.
Well, I don't think the Fed's going to be loosening the reins on liquidity anytime soon. The problem is there's just too much debt, and even in the last 10 months or so since the repo liquidity crisis that started last year in August, the government has issued more debt here in the U.S. than the Fed has printed up in balance sheet expansion. Close to $4 trillion of new debt, and just over $3 trillion of Fed money printing. And I think we're going to find that the problem is there's just too much debt, whether it's corporate debt, whether it's government debt, whether it's household debt. And this is a global problem. It's not just a U.S. problem. And so unfortunately, we have to get through a recession and a bear market, and this liquidity is going to be around for a long time. Low interest rates too. But it doesn't justify high stock prices, and I think people are going to start to realize that there's also inflation risk down the road on the horizon because of this interest rate control, and I think we're going to see yield curve control coming down the pike. But people are going to realize that there is an alternative to overvalued stocks, and that today is cheap precious metals. And the precious metals global mining industry, for instance, is less than 1% of the global market cap of equities. We've been through a 10-year bear market, and I think people are going to start to realize that all this liquidity is actually very bullish for precious metals, and could be very bearish for stock prices.
Yeah, no, I'm going to come to your big call on gold and precious metals in just a bit, Kevin, but I'm going to pin you down to something that you wrote in a note to your investors, I think back in late 2017 or early 2018 it was. I mean, at that point also you called for, you basically pointed out that valuations relative to underlying earnings fundamentals were just out of whack, completely out of whack. But the rally kept going in US stocks, right? I mean, if you were sold back then, you would have missed next 2-3 years of great moves. Why should it end now, Kevin, is the question.
Well, we've had a true fundamental downturn, and certainly COVID-19 was one of the catalysts for that. The unemployment rate has shot up. We've lost over 20 million jobs here in the U.S. Unemployment rate has shot up globally, and this is the global recession was coming after a record long 11-year expansion here in the U.S. because of the debt, because of the asset bubbles to begin with. And when you create speculative asset bubbles, whether it was the housing bubble in 2006-7, whether it was the internet tech bubble in 2000, ultimately bubbles burst, and those bubbles are create a reflexive downturn in the economy. And we haven't seen this bear market play out. There's still a lot of speculative mania out there, and it's something that is destined to unwind. And like I said, I think it's people realizing that there's an alternative, and we haven't seen. We've started to see the move into precious metals, but it's been a 10-year bear market. So there's still a lot of room for asset prices to decline in stocks and bonds, and for precious metals to appreciate.
Yeah. Kevin, we highlighted this a few weeks ago here as well, that retail participation here in India, in the US, Japan, Korea, I mean, is exploded because people are at home, and maybe they want to dabble in stocks. It's true in the US as well, Robinhood and whatnot, right? How does retail participation as a share of total market volumes in the US compare to, I mean, the previous sort of peaks in 2006, 7, 8 to the 2000 period? Are we there yet or not quite?
Well, there's certainly the speculative mania among the retail crowd, like there was in the 2000 tech bubble. There's a lot of comparisons to the tech bubble, especially in terms of valuations of tech stocks and of growth stocks in general. And at the same time, it's not just growth stocks that are overvalued. Cyclical stocks that are heavily indebted and have terrible fundamentals in this current recessionary environment that we're in are also overvalued. And so it's so the speculation is there. The economic downturn is there. It's just that there's the liquidity is driving a general stock market rally, and I think we need to see. Wait till these Robinhood traders learn about gold mining penny stocks. I mean, there is going to be a rotation.
Well, absolutely, Kevin. Just one last question on stocks. Your thoughts on emerging markets? Do you have any money allocated in emerging markets? Any thoughts specifically on India at all? Markets like India, where does it sit relative to, I mean, the US market, and how do foreign investors think about these markets?
Well, we certainly like India a lot better than China today and some other emerging markets. The biggest concern that we have is that we believe we're in a global debt bubble and in a global economic recession today, and we think that still has to unwind. And until we really see the dollar falling here in the U.S., and I'm afraid there's one emerging market that is still an even bigger bubble than the U.S., and that is China. They've created over $40 trillion of credit in their banking system, and it's just unprecedented. And when we really get this big China devaluation that we're looking for, and that kind of last dollar rally, and then the Fed has to come in, really heavy at that point. I think there's room for one more big dollar rally, and it's not until the dollar really starts to fall that you can get excited about emerging markets. And in India, we just need to do more work. Every time I've looked at India in the past, it's been kind of an expensive market to me, and it's just been a little bit hard for me to get my arms around it. But it's one that once the dollar starts to weaken, we will certainly be looking at.
Okay. Okay. Let's come to gold now, Kevin. So what are your projections? I mean, it's been around for thousands of years. The oldest sort of hard currency in that sense. The arguments are many, and they've been made over and over again over the years. But so far, it's not really taken off the way that many expected, right? The same arguments could have been made in 2007-8 as well. Why do you think this time it'll be different, and gold will be the asset class to be in over the next couple of years?
Well, gold is simply undervalued today, and it's undervalued relative to global fiat money. And with global debt to GDP at $255 trillion of global debt, the highest ever relative to the GDP. We really believe that that gold is going to come into its own, but gold is undervalued relative to the global fiat monetary base. We have a target price of over $3,000 just based upon the amount of money that's already been printed, and that's only going to be increasing. So it's a moving target. Gold is the most predominant central bank reserve asset, reserve currency, really, that is owned by every central bank in the world, and it's the longest running central bank reserve asset. It's the most ubiquitous, and today treasury departments of countries have, in their best national interest, they have a duty, a fiduciary duty to look at their reserve assets, and they have to decide, do I want to buy overvalued global sovereign debt that yields practically nothing, and in some cases negative, or should I be looking at undervalued gold today? And so there's an alternative with central banks as well, and I think we're going to see treasury departments of the world's nations really start to acquire gold. We've already seen it. There's a chance that the U.S. Treasury Department gets into the game here. So I think there's a big long road ahead for much higher gold prices.
Kevin, thank you so much for joining us here on CNBC TV 18. Really appreciate your time. Thank you very much for staying up for us.
Thank you, Prashant.
There. Thank you indeed. And we'll have you back soon again as things start to happen out there in the US, as you're expecting they will on the downside. Thanks indeed. Kevin C. Smith, founder, CEO, and CIO at Crescat Capital there from the US. We will take a very quick break here, the first on the show here. We are back, and hopefully my colleague Surabhi should be with us as well on the other side. Stay with us.